The deal seems like it has two goals: delivering relief to some homeowners and former homeowners, and compelling five big banks, Wells Fargo, Bank of America, JP Morgan Chase, Ally Financial, and Citigroup, to pay up and admit they engaged in fraudulent behavior. It took 16 months to hammer out. What are the core provisions of this settlement?
Well, it actually does two things, and you mentioned one. One is to bring direct, imminent relief to the people who are the very victims of the conduct of the bank, the very heartless, soulless conduct of the banks that actually led to many people being foreclosed upon. And even if you're not somebody that was foreclosed upon, you felt the impact because the foreclosure crisis then led to the economic downturn that affected everybody. So that is the one thing. And you mentioned the five major banks. Those are the big banks. The next thing the attorneys general will do is go after the next 9 biggest banks. So ultimately we'll actually bring well over $1 billion into Maryland. The reason why it took so long to accomplish in terms of the deal, the robo-signing revelations came out, if you recall, in about October of 2010. The deal, that we were able to use that to do in-depth investigation with our federal partners as well, and found a number of very disturbing violations and insidious conduct conducted by the banks. So the problem, though, is what would we be giving up? In other words, we're getting an enormous amount of money here, Maryland disproportionately so. And what is it we're giving up? Well, at the end of the day, we ended up giving up just state claims and federal claims regarding the origination of those loans and the servicing of those loans. The big sticking point was the banks wanted us to waive any claims regarding the securitization of those loans. That is, the banks that took these loans that were subprime loans, knowing full well the people were not going to be able to satisfy those loans, packaging them together and then selling them to investors. We were unwilling to waive those loans. So we only gave up the origination piece, which of course most of the originators are long gone by now. Most of those claims have actually been the statute of limitations is told on those claims. So it's really the servicing piece of that. We did not give up any ability to bring fair housing claims, any ability to bring MERS claims, any civil rights claims. As I mentioned, we didn't give up the securitization claims, nor did we give up claims for any individuals. In other words, if an individual could show that the fraud that perpetrated by the bank directly led to their being foreclosed upon, they can seek up to full restitution. So
that individual can himself or herself sue.
That's right, exactly. And the second thing I was going to mention that we did, besides the big money piece, is that there are 42 pages of industry standards now put into place that will be used by the industry going forward regarding servicing, so that we will not, that the banks will be unable to wreak this type of havoc upon our citizens again in the future. Of the almost $1 billion, and unfortunately Maryland was disproportionately impacted by the foreclosure crisis, and the fortunate piece, therefore, is that we're getting more money than New York. I mean, we're getting the 6th most money in the country as part of this 50-state deal.
Maryland gets $960 million, Virginia $480 million, and the District of Columbia $45 million.
For example, we get a double of what Virginia gets because, unfortunately, we have so many folks that were there. The way the money comes in, though, is 4 different pools. So there's the pool of people that have been foreclosed upon. That is, they're no longer in their homes. They get a check of $1,800 to $2,000 estimated, which, again, they can still bring their own claims, but it's basically a windfall for them. Then there's the pool of people who are currently underwater. That is, they have a huge negative equity in their home. That's a
large pool.
That's a large pool. And let's say they live in Prince George's County and they're paying now a $300,000 loan for a house that's now the actual value of that house is, say, $170,000. They would be unable to refinance under normal circumstances because of the negative equity. The banks will now allow them to refinance and do a loan modification such that their interest rate on their payments will go down significantly. Those are people that are actually up to date on their payments, but they're underwater in terms of the future. The largest sum of money will be write-downs by the banks going directly to principal reduction, which is huge. 60%, for example, in Maryland, $809 million of this is that pool. And that 60% of that money has to be used for principal reduction and loan modification. So this helps the banks as well, because now they're not going to have to foreclose upon people and have these empty houses sitting there. They're actually going to have income coming in. The final pool is a smaller one, which will be money that's administered sort of by the Attorney General's office, my office in Maryland, and every individual Attorney General in the country, which will be used for housing-related projects. In particular, one of the places we're going to invest a lot of money is on housing counselors and legal assistants. It's one of the few things that's actually been proven to work. If you're sitting there, you're doing loan modification, you have a housing counselor next to you, there's a 70% chance you'll still be in your home 6 months from now. If you don't have a housing counselor, 20%. So we want to make sure there's adequate housing counselors to take advantage of this program with the people in Maryland.